Hello everybody. Today I'm here to talk to you about UTI Focused Equity Fund Series 5. This is a close-ended fund from UTI, and we call it the Focused Equity Fund because it has a strategy of picking only a select set of stocks. And we look at some of these parameters, be it the fiscal deficit, the current account deficit, inflation, etc. What we see is that on most of these parameters, these parameters are somewhere closer to the left end of the scale, which is to say that there is still room and headroom, more importantly, for these parameters to move higher as the economy goes through a positive growth cycle. So I think from the point of view of macroeconomic stability, this is one of the best platforms that we have had in a very long time, and it certainly sets in place a platform from which the economy can target much higher rates of growth in the years ahead. If you look at the slide on the screen right now, this essentially shows you what has been the pattern of fund flows into the market over the last decade. And I think what is very remarkable is that if you look at those bars in the chart, the blue bars reflect the inflows which have come from FIIs, and the orange bars reflect the flows that have come from domestic investors. And in the last 3 years, what is very clear is that the domestic investors have played a far more dominant role, investing large amounts of money into the market, and certainly far more than what foreigners have been investing in the market, which is a reversal of a trend that if you look at the left side of the chart, in the past it was the blue bars which were dominant and the domestic investors, the orange bars, were a very small constituent. This, I believe, is a very welcome trend because again it makes the market far more balanced. So at this point of time, what we do believe is that it is very important for earnings growth to begin to come through, to be able to sustain market valuations at these levels. There is certainly some degree of risk posed to the market just on account of these valuations, and we do think that the ingredients are in place for a much faster growth in earnings over the next few years from a macro perspective. So we have approached this entirely from a bottom-up perspective, and we have analyzed all the companies. At UTI we carry out research on 345 companies, and then we asked each of the analysts which are the best ideas that they have in their individual sectors, and then they gave us a basket of stocks that each of them thought was their best ideas, and these were essentially shortlisted based on 3 criterion. First, which are the companies which are likely to have the strongest earnings growth over the next 3 years? Secondly, which are those companies where currently return on capital is slightly lower than their long-term average, but the analysts believe that over the next 3 years return on capital might improve back above the long-term averages, or at least to the long-term averages. And finally, which are those stocks which are currently trading at a discount to their medium-term valuation, meaning that there is some headroom for these valuations also to move up over the next 3 years. So these were essentially the three filters that we applied to the best ideas that the analysts gave us, and eventually it is our intention in this particular portfolio strategy to create a portfolio certainly less than 30 stocks. In fact, it's more likely that it will be closer, as I said, to about 20 to 24 stocks. The 4 themes that are highlighted today that I'm going to talk to you about, the first is financials, the second is pharmaceuticals, the third is logistics, and the fourth is consumption. So these are 4 themes that will certainly find reflection in the portfolio. But again, just to repeat, these are not necessarily the only themes that will be reflected in the portfolio, because the portfolio will be more diversified than across just these 4 themes. It's a good point also for me to once again wrap up and give you some perspective on the overall parameters with which the portfolio will be constructed. To repeat, it will have not more than 30 stocks. Ideally, in fact, we intend to run with only about 20 to 24 stocks in the portfolio. There is no style bias to the portfolio, which is to say that it will be both growth and value combined in the portfolio. It also does not have any inbuilt market cap bias. We expect it to be a portfolio which is more sort of multi-cap in nature, but we do think that the large cap tilt of the portfolio typically would be somewhere in the region of about 50 to 60% of the portfolio would be large cap. Finally, the normal risk parameters that we apply to any portfolio that we run at UTI would also apply to this fund, which is to say that we would not have more than 35% invested in any given sector. and we would also not have more than 9.5% invested in any given stock. So these are the normal risk parameters that will also apply to FEF5, and these are prudent norms that we think eventually are in the interests of investors. So finally, in conclusion, we do think something like FEF5 does have space in your portfolio. Obviously, this is not a core diversified fund, and therefore really we would put this more in the category of specialty or thematic funds. But most investors could do with some exposure to this particular theme. Whether it should be 5% or 10% is something that you're best placed to discuss with your advisors, and take a judgment on how much allocation you could have. But we do think that again, this is a portfolio structure that is well placed to benefit from certain trends and themes which are playing out in the economy today. And thank you very much for your time and attention today. And if you have any questions, I'm sure the team here will be happy to respond to them.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.